Okay, so our discussion for this session will be IAS 37, Provisions, Contingent Liabilities, and Contingent Assets. So for the short introduction of the history of this standard, it was actually been in existence since 1998 pa. Although it was from the old standard setting body, which was International Accounting Standards Committee. Okay? Actually, way back pa, meron pa yung prior na 1978 version. So, basically, from 1978 version, we have the 1998 version, and then we have the 2001 version. From there are additional requirements or additional changes that were done to the standard because it relates to other topics such as yung onerous contracts natin, which was relating to the May 2020 modification. Anyway, this standard is already the standard that we are going to discuss is already the updated one. Also, because of the changes in other standards such as IFRS 9, IFRS 7, IAS 39, and other improvements and other standards, new standards, particularly the new IFRSs such as IFRS 15, 16, 17. Okay? So, the standard needs to be modified. Although, these are only minor changes. It does not really affect the totality of the items of provisions, contingent liabilities, and contingent assets. So, if you whatever you learned in your previous subjects in your lower years, that's still applicable up to now. Okay? So for the content of our discussion, the standard has a total of 95 paragraphs, and it will discuss the main items such as the scope and definitions. We have the recognition criteria, the measurement criteria. We have reimbursements, changes in case there are changes in the provisions, the purpose and uses of your provisions, the application of the recognition and measurement rules that are stated in the earlier paragraphs, okay, which is also going to focus on the other items that were stated in the introduction, such as future operating losses, onerous contracts, and restructuring, because this is also going to result in provision. We have disclosure, and then the final paragraphs, which are transitional provisions and effective date, which is actually not so much of an issue anymore because this has been in existence already since the earlier parts of the previous year. So no need or we're just going to run down the provisions, but these items are not necessarily important anymore because it is already after the expected effective date. So let us start with the scope and provisions first. The scope and objectives. So under IAS 37, so the objective is basically to make sure that an entity is capable of appropriately recognizing your provisions, contingent liabilities, and contingent assets based on the requirements that are set by the standard. So basically, an entity needs to be able to correctly classify and qualify items or transactions that happened or past transactions that have been where the entity has been involved in order to determine whether provisions, contingent liabilities, or contingent assets need to be recognized in the financial reports and whether there are items of expenses or items of income that needs to be recognized in the statement of comprehensive income. So for the scope, basically, if you look into the provisions, if you see items that are deleted or stated as deleted, this simply means that there were items that were once added there or provided there. However, it is no longer applicable because when the changes were made, it's either these items that were deleted were already incorporated in other standards, or they are now being covered by a specific standard. Therefore, if it is deleted, no need to worry. It simply means that the original provisions were now modified, and uh, items that are no longer applicable are already removed from the provisions. Okay? So for the scope, the standard states that IAS 37 shall be applied by all entities in accounting for provisions, contingent liabilities, and contingent assets, except letter A, those resulting from executory contracts, except where the contract is onerous, and those covered by another standard. So basically, if an item is an executory contract, or an item is covered by another standard, similar to how we explained it before, it will no longer be covered by the standard, which is IAS 37. And take note, unless it is an onerous contract, because if as we discussed in the table of contents a while ago, onerous contracts are already part of the components or part of the scope of IAS 37. Okay? So the standard does not apply to financial instruments that are within the scope of IFRS 9 because it is already covered by IFRS 9, so no need to provide specific items in IAS 37 because it is already covered by another standard, as reiterated in item C of paragraph 1. So, since it is stated here that executory contracts are not within the scope of the standard, let us understand first what do we mean by executory contracts. So it says here that executory contracts are contracts under which neither party has performed any of its obligation, or both parties have partially performed their obligation to an equal extent, and this does not apply to executory contracts, or the standard does not apply to executory contracts because in the first place there will be no provisions to be provided because the contract has not yet been consummated. Take note, it is executory. Okay, so meaning it is not yet completed, and therefore it is not necessary for the entity to provide provisions in their in their financial statements. Okay. However, if an executory contract becomes onerous in nature, it becomes an onerous contract. It will now become part of the scope of IAS 37. Right. So similarly, just like how we discussed it before, if another standard is already covering a certain type of liability or certain type of obligation, then it will no longer be covered by IAS 37. Okay? And examples are income taxes, which is covered by IAS 12, leases, which is covered by IFRS 16, employee benefits, covered by IAS 19, insurance contracts, which is covered by IFRS 17, and contingent considerations, meaning liabilities that will be recorded by an acquirer in relation to a business combination, which is covered by IFRS 3. And finally, we have letter G, revenues from contracts with customers. So meaning whether we're going to recognize an unearned income. Okay? So it is covered by IFRS 15. So it is no longer going to be part of the considerations in IAS 37. So that's basically the concept there. Okay. So with that, before we proceed with the definitions, we just need to understand that IAS 37 covers three items. We have first, provision, which is defined, okay, although it is still going to be defined here. So it's going to be the standard covers provisions, which are items of liabilities that are uncertain as to either timing or amount. We are going to cover contingent liabilities, which are not yet liabilities but are potentially or can potentially become liability, so it needs to be disclosed to the reports or to the disclosures of the entity. And contingent assets, which are not yet assets but could possibly become assets in the future if certain conditions are met, which are also going to be disclosed when certain requirements are met. Okay? So, let's go first to paragraphs 8 and 9. So, the standards specify whether expenditures are treated as asset or as expenses. Okay? So, other standards. Okay? These issues are not addressed by the standard because it is already covered by another standard. So, an example here is that if we are going to make a provision for decommissioning cost or restoration cost, the restoration cost itself or the provision itself is going to be covered by IAS 37. Okay, because it is a provision. However, whether the provision that was credited, because if we prepare the journal entry, the decommissioning cost or the expected decommissioning cost is actually going to be on the credit side. The question there is it going to be debited as a capitalizable cost or as an expenditure? Okay? Paragraph 8 specifically states that it is no longer the responsibility of IAS 37 to provide the conditions of its capitalization or the expensing of these particular items, because it is already dependent on what kind of asset or what kind of transaction it is, and it is already covered by another standard. So meaning, since we had a discussion previously which is relating to your exploration and evaluation assets, okay, whether or not some items will be capitalized or will be expensed outright, if a provision was provided or if a provision is going to be recognized in the liability section, IAS 37 will cover that. But whether or not the provision is going to be capitalized or expensed, it is not covered by IAS 37 anymore. The entity should refer to the specific standard that covers the capitalization or expensing of a certain item. Okay? And finally, before we go to the definitions, the standard applies to provisions for restructurings. Okay? And when a restructuring meets the definition of a discontinued operation, additional disclosures may be required by IFRS 5. Because restructurings or situations wherein an entity needs to have a fresh start or to make modifications in its operations in order to address certain uncertainties. Okay, this is already part of IAS 37. However, if the restructuring is relating to discontinued operations, of course, since it is part of IFRS 5, then additional requirements might be needed in accordance with the IFRS 5 provisions. Okay? So with that, let's proceed with the definitions. So these are simple terms. We have first the provision, which is basically pertaining to liabilities that are either uncertain as to timing or uncertain as to amount. If both are uncertain, okay, both timing and amount are uncertain, we cannot recognize a provision. Take note that that either, okay, but not both, okay, should be uncertain. For in the case of liability, this is the definition provided by your framework. This was actually adopted because provisions are actually liabilities. Okay. The next one is obligating event. So an obligating event pertains to either a legal an obligating event pertains to a past transaction which created either a legal or constructive obligation. We have a legal obligation, which are obligations that were derived by the entity from a contract, from a legislation, or from other operation of law. So by concept of elimination, any item that is not a legal obligation is considered to be a constructive obligation. Although there are also specified items or definitions that are stated to determine a constructive obligation. So it says here, a constructive obligation is an obligation that derives from an entity's action where, letter A, by an established pattern of past practice, okay, an entity will generate an obligation. So meaning they created a responsibility or an obligation to another party because this is part of the practice, the policies, or the um, or whatever they were doing with similar transactions that they have been doing before. And letter B, as a result, the entity has created a valid expectation on the part of those parties that it will discharge those responsibilities. So in other words, for constructive obligation, supposedly you do not have an obligation because it is not a requirement, because it is not part of the contract, it is not part of legislation, it is not part of the operation of law. However, because of the entity's practice, policies, and others, okay, or other documents or whatever, it is now creating an obligation on the part of the entity. Okay, so that's basically what constructive obligation is. So if we talk about warranties, warranties are considered to be legal obligations because it is part of legislation. There is actually a law that requires or that sets an obligation for entities who sell products to have warranties. If we talk about premiums, premiums are not actually considered as legal obligations because in the first place, premiums are not required to be given to customers. However, as a matter of practice, it becomes a constructive obligation and therefore we also need to recognize a liability for premiums. Okay, so um, that is how it works. Okay. However, again, before we move on, premium liability can be constructive. It can also be a legal obligation if a contract exists between the entity and the parties who are supposed to receive the premium. Okay, so it's either way because it depends on the nature of the premium. Okay. Next, we have contingent liability. So again, when we talk about contingent liability, it is not yet a liability. So if we go to the probability levels, which is we have remote, we have possible, we have probable, and we have virtually certain. If it is still in the level of possible, okay, so it is not yet probable, it is not yet virtually certain, so it is still considered as a contingent liability. However, when the level of probability is already on the portion of probable until virtually certain, then it becomes an actual liability and it will now be upgraded to either a provision or another type of liability such as accrued liabilities or other payables. Okay? So, a contingent liability is a possible obligation, okay? And it is not, however, it is not yet recognized because just like what I said, it is not yet probable, okay? And the amount cannot yet be recognized or it cannot be measured reliably. Okay? In the case of contingent asset pertains to a possible asset, meaning it is not yet an asset, but an entity could possibly have or obtain an asset out of a past event. Okay? So the reason why it is not yet, it cannot be recognized as an asset yet is because the entity has no control over the passing or over the transfer of that particular asset from another entity going to the entity that is reporting the contingent asset. Okay, so that's why since it is not yet certain or it is not yet within the control of the entity, then it is going to be considered as a contingent asset which is going to be disclosed. Okay? We have two more items. We have onerous contracts and restructuring. So when you talk about onerous contract, this is pertaining to a contract wherein the 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 obligation that is going to be paid by the entity or is going to be incurred by the entity is actually higher as compared to the expected benefit, or it is possible also that the entity does not have any benefit at all but has an obligation to pay something. So that makes the contract onerous. So for the technical term, an onerous contract is a contract in which an unavoidable cost is meeting of meeting the obligation under the contract exceeds the economic benefits expected to be received under it. Okay? So, there are two possible cases again. Okay, just to reiterate, under an onerous contract, it's either the cost is greater than the benefit, or there is a related cost but no benefit is going to be expected. So in any case, we always consider that there is a cost involved, okay, that is higher than any benefit to be expected. Okay? The benefit being lower than the cost or zero. Okay? Next, we have restructuring, which is a program that is planned and controlled by management and materially changes either the scope of the business or the manner the business is conducted. So, in any case, restructuring simply means a change in the operations. Okay? So, with that, we now proceed with provisions and other liabilities. Okay? So, provisions, okay, can be distinguished from other liabilities such as trade payables and accruals because there is uncertainty about the timing or amount of the future expenditure required in settlement. Okay? So that's the main or that's the main thing that distinguishes provisions from other liabilities. Okay? Such as those that are provided here, wherein we have trade payables and similar items and accruals. Okay? Because in the case of trade payables, okay, both the amount and the timing of the payment is actually determinable because the payment of the trade payables is based on the contract entered into when goods or services were availed of by the entity. Okay? So it cannot be recognized as a provision. Accruals, okay, are also not considered as provisions because first, the timing of the payment is obviously known because when you accrue something, you know you are accruing something because you know that you're supposed to recognize a portion that you're going to pay later on. The amount is also certain because accruals are based on goods or services that you also availed. Okay? So therefore, trade payables and other accruals should not be looped or linked together with provisions. They should not be considered under one line item. Provisions are considered to be a separate line item. Okay? So, relationship between provisions and contingent liabilities. So, although you will have a copy of this particular items, okay, as provided in the other videos and other slides. The only thing that you need to understand that there is actually a link between provisions and contingent liabilities because there is a probability, or actually most of the time a contingent liability will become a provision or will be upgraded into a provision when the requirements are already met. The only reason why contingent liabilities cannot yet become provisions is because of the level of probability. Once the contingent liability becomes probable, okay, meaning before it was possible, now it becomes probable, then it will now become elevated or it will be elevated into provision already. So that's simply the link between those two. Now, it can also happen that a provision can be downgraded into a contingent liability. The reason is because the probability level of the obligation happening was also downgraded from probable into just possible. Okay? Because we need to understand that there are various reasons why we are recognizing provisions or contingent liabilities. And most of the time, these are transactions where the entity becomes involved, but it is beyond their control as to whether they are going to be liable or not. So meaning, it is either dependent on the provision of the law, it is dependent on what's going to be the result of the extrajudicial settlements. It is going to be based on the decision of other parties. Okay? So meaning, it is really not beyond their control. So the level of probability is not within the control of the entity, and therefore a certain liability can be transferred from the two categories, okay, from provisions to contingent liabilities or contingent liabilities to provisions, depending on the underlying settlement or underlying court case or underlying obligation that is still being settled. Okay? Now, we go to recognition. Okay? So, it's basically determining whether the obligation that you are currently involved in, whether that is legal or constructive, is considered as a provision or not. Okay? In the case that the item satisfies the definition of a provision wherein there is already a present obligation, a probable outflow, and a probable or a reliable estimation of the amount, then we are now going to recognize the provision. Okay, so that's basically the recognition criteria. Okay, first of all, it satisfies the definition of a liability. Second, there is probable outflow of economic benefits. And third is the amount can be measured reliably, whether it is just an estimate, because take note, provisions are just estimates. Okay, and it was reiterated, if these conditions are not met, no provision shall be recognized. Okay, so let us dissect the concepts here in letters A, B, and C. So what do we mean by present obligation? So present obligation simply means that a transaction has already transpired. Okay, meaning there is already an obligation that was established. Okay, however, we do not yet know, we are not yet sure how much and when we are going to pay for it. Okay, however, we also need to understand that because it is a present obligation arising from a past event, there needs to be an underlying event that transpired. Okay? And again, going back to the sources of your obligation, the past event would either be resulting from a legal transaction, meaning a contract, a legislation, or other operations of law, or constructive, which is pertaining to the policies of the entity or practices of the entity. Okay? So if those happens, okay, if those items happen, then a past event has already occurred, and it will now generate a present obligation. Okay? Now, we will not go through with the items because these are basically just examples and deeper explanations, but that's the gist of everything. Okay? Next, probable outflow of resources. We already know what it means by probable outflow. Okay? Just to give us the specific discussion, no, and for us to have a better idea, there, just like what we said, there are basically 4 levels here. We have remote, possible, probable, and virtually certain. If we're going to rely on um, percentages, okay, percentages to for us to determine what is remote, what is possible, what is probable, and what is virtually certain. When we talk about an outflow that only has a 10% chance of happening, that's actually considered as remote. Okay? If the chances is 50 or below 50%, okay, or 50% and below, that's considered to be possible. Okay? It is now considered to be probable if it is higher than 50%, okay, but not higher than 90%. Okay? And if it is 90% and above, it is considered to be highly virtually certain. Okay, so that's basically the concern there. So when we say probable outflow, we simply need to consider the event or the obligation, or we need to consider that the obligation is going to be paid by the entity on a probable level, which is more likely than not. So if it's more likely than not, if we're going to use the percentage, then it's going to be 50%, or sorry, above 50%. Okay, so that's going to be our evaluation there. So in percentage, is going to be greater than 50%. okay, but not more than 90%. If we're going to simply use that terminology, so probable simply means more likely than not. Okay, so that's basically how it works. Okay, next, reliable estimation of the obligation. We need to understand that it is possible that the amount is certain, but it is also possible that the amount is not yet certain, but it can be estimated. Most of the time, certain types of estimations are going to be used, okay, such as the median of the range, the most the expected outcome. What else? We have the single most probable amount. So it depends. Okay. So this the estimation or the reliable estimation is of course going to be justified by the entity who provided that estimate. Before an entity can state or can declare that the estimate is reliable, they need to provide evidences, they need to provide proof, okay, that the said estimate is actually reliable. So, in cases of the estimation, it could either be an amount that was stated by a professional, an amount that was estimated by the court, an amount that is estimated by your legal counsel or whoever. Okay, for as long as the person who is providing the estimate or who computed the estimate has legal authority and capability of doing the said estimate. Okay? Now, with that, we go to contingent liabilities. So for contingent liabilities, just like what I said, it is not a problem, okay? Because if it is not yet a provision, then most probably it is a contingent liability. So in case of percentage, if the probability of the obligation, okay, of being paid is 50% and below, but not going to reach 10%, okay, then most probably that is considered as a contingent liability. And there is no problem because what you simply need to do is to disclose the contingent liability and the pertinent facts of the contingent liability for full disclosure purposes. So there's no need to have any problem with that. Okay? So again, the contingent liability can become a provision once the probability level is already exceeding 50% or is already becoming more likely than not. Okay? In the case of contingent asset, the only thing that we need to understand here is that if the control over the contingent asset becomes or is already transferred to the entity, then it will become an actual asset. So in other words, when the probability is already virtually certain or 90% and above, if we're going to use estimates or if we're going to use percentages, then that's the only time that it will become an actual asset that will be recognized. Okay? If the probability of the asset being transferred is 90% and below, meaning it is not yet virtually certain, then the only thing that you're going to do is to disclose it. Okay? And then, of course, if the probability is remote, most of the time, we do not really disclose that. You are not required to disclose either an asset or a liability that has only a 10% chance of coming to fruition or only has a low percentage of actually being transferred to the entity. Okay? So just a general rule or just a general guideline, if it is already remote, if the probability is remote, you can actually ignore it. But for purposes of, since the standard is principles based, if you still believe that the disclosure is necessary, even though the probability is remote, you can still do so. But as a general rule, just so we know the basics of remote, possible, probable, and virtually certain, we need to know how and when we are going to recognize and when we are going to disclose. Okay? That's basically for the three items. Now, let us go to measurement. Just like what I said, it is possible that the entity will already know the amount. Okay? But most of the time, if we are talking about provisions, we need to recognize the amount based on estimates. Okay? And when we talk about estimates, okay, what we need to look for is the best estimate. Okay? When you talk about best estimate, it pertains to the amount recognized as a provision, okay, that is going to um, represent, okay, represent the expenditure, okay, required to settle the present obligation at the end of the reporting period. And best estimates can be computed in different and a lot of possibilities. Okay? So, just so we have an idea of how we can determine best estimates, we already stated a while ago that we can use either the most likely outcome. Okay, so meaning we can determine even if there is a range, even if there is a range of possible payments, if an expert or if an authorized person can pinpoint the most likely outcome, then you can actually provide that. That can be the amount of your provision. If there is a wide range and each of the amounts within the range are as likely as the others, then to simplify, you can actually get the median or you can get the midpoint of the range. Okay? So that's basically how we can do it. So most of the time, that's the two. So we have most likely outcome, we have midpoint, and the third one is probability weighted. So meaning, examples that you can encounter is that there is a 10% chance of this amount, there is a 50% chance of this amount, there is a 30% of this 30% chance of this amount. So you're basically weighing the amounts, okay, based on the expected probability. So that's probability based. Okay, so there. But we simply need to understand, because paragraph 41 is very important, the provision must be before tax. Okay, because the tax consequences will be dealt with in IAS 12. Okay, so this should be before tax because the tax amount will be computed later on the latter part of the statement of comprehensive income. Okay, next, in measuring, we also need to consider the risks and uncertainties. Okay, so when we talk about risk and uncertainties, we of course need to understand that there is a, because the probability is not 100%. Okay? Because the probability of the provision is not 100%, we need to adjust the amounts that we have arrived at to reflect the risk and the uncertainties involved. Okay? The risk and the uncertainties could be pertaining to the amount, it could be pertaining to the period of payment, it could be pertaining to both. So what are we going to do? Okay? So when we have already an estimated amount, we need to consider if we need to adjust it for risk-related considerations. Now, as an accountant or as a CPA later on, we do not actually have the expertise to do this unless you also have a license for actuarial or actuarial assumptions or actuarial expertise. Okay? So when you talk about actuarial expertise, this pertains to and the ability to consider amounts and make computations, and you are an expert in assessing the risk and determining its financial impact. Okay? So that's basically how it works. So most of the time in the board examination, the risk percentage is already established. Okay? So the risk percentage is already established. Okay? And number two, uncertainty of the payment. So because of the uncertainty of payment, we also need to adjust our estimates based on present value factors. Okay? So those are basically the two items that we're going to consider in the estimation or in the computation. Okay? So later on, you will encounter in problems wherein there is already a risk adjustment factor and there is also a present value factor, because we need to make sure that the amount or reflects both risk, uncertainty, and of course the timing of the cash flows. Okay, so that's basically how it works. Yan. So we talk about present value, and of course we also talk about future events. So present value is pertaining to the timing of the payment. Okay, so we need to adjust the amount of estimate based on how or the period of time from the reporting period and the settlement period. Okay? So why is it that future events, okay, future events are considered here? Okay, so let's just read through paragraph 48. Future events that may affect the amount required to settle an obligation shall be reflected in the amount of a provision where there is sufficient objective evidence that they will occur. Okay? So the future events pertains to the adjustments also for risk and uncertainties. Okay? So because future events will change the risk, will also change the risk level, and will also change the uncertainty level. So therefore, if any future event happens, whether that is during the reporting period or prior to the settlement, or at the end of every period, you need to modify or change your estimates. Okay, so meaning there needs to be a change in accounting estimate. Okay, whenever there are additional data, okay, that can help or that will change the amounts that we're going to recognize. Okay. Next, expected disposal of assets. Okay, so it says here, gains from the expected disposal of assets shall not be taken into account in measuring a provision. Why? We need to understand provision is a liability. Okay? Gains. Okay? So if there is a liability, it is possible that we're going to have an expense later on. Okay? So because whenever there is a liability, most probably that is going to be an expense if we're talking about an obligation. Okay? If we are expecting gains, okay, from assets that we're going to dispose of, that should not be netted off with the obligations. Because take note, we need to recognize separately the gains from the expenses. We need to recognize separately the assets from the liabilities. That's why any expected gains should always be recognized separately. Okay? And it should not affect the provision. Okay. Next, we go to the concept of reimbursements. Okay? So whenever there are expected reimbursements in settling an obligation, we always, similar to what is explained here in expected disposal cost, we simply need to understand that the reimbursements should not be netted off from the provision, because reimbursements, okay, are not related to the original provision or original obligation that we have. Just to give us an idea, it's like this. If damage or if something happens to the entity which results to the entity needing to pay another party for damages or for whatever obligation, that will be recorded as a provision or as a separate liability. If the entity expects to receive compensation or to receive reimbursements from an insurance company or for another or from another entity as a result of the provision, the said reimbursement should not be netted off from the provision, because these two are not related or are not directly related to each other due to the fact that there are different parties involved in the settlement. Okay? So the provision needs to be settled with the damaged party or the party that sustained the damage. The reimbursement is going to be between the entity and the insuring company or the company that will give the reimbursement. So therefore, it is not a transaction that can be netted off because of the different parties involved. Okay? So that's basically the explanation for reimbursement. So in simple terms, just remember, in case there is a reimbursement, do not net it off from the provision. Instead, you recognize it as a separate asset. Okay? Next, changes in provisions. Okay? So whenever there is changes in provisions and connected in connection also with future possible events that's going to happen. So whenever there are changes in provisions, always treat it as a change in estimate, and therefore it is going to be is going to affect only the current and subsequent periods. it is not going to affect the prior period. So therefore, no prior period adjustments will be made. So in this case, if let's say for example, sorry, if let's say for example, you overestimated your provision and in the current period, you need to reduce your provision. So what are you going to do? You debit the provision and you recognize a gain on reversal of provision. So that's basically how it works. What if you underestimated your provision? Then what you're going to do is to debit additional expense and credit additional liability. Okay, so that's basically how it works. So this simply means that whenever there are changes, it will be reflected in your statement of comprehensive income, and it will not affect the prior periods because this is a change in accounting estimate. Okay? Next, use of provisions. A provision shall be used only for expenditures for which the provision was originally recognized. Okay? So only expenditures that relate to the original provision are set against it. Setting expenditures against a provision that was originally recognized for another purpose would conceal the impact of two different events. So in other words, do not mix two items of provisions, okay? Because it is going to go against the concept of full disclosure, okay? Because whenever they are set against each other, okay, or they are going to be offset, okay, then it's actually concealing the impact of two different events. So you always remember there should be no offset of provisions, okay? There should be no offset of provisions. Okay. Next, application of the recognition measurement rules. Okay, first, what in the case of future operating losses? Okay, so are we going to recognize a provision for future operating losses? The answer is in paragraph 63. Provision shall not be recognized for future operating losses. Why? In the first place, it violates the definition of a liability because a future operating loss is not yet a past event. And since there is no past event yet, there is no transaction. Okay? There is no transaction and there is no obligating event yet. So therefore, we are not supposed to recognize that. Next, how about for onerous contracts? Okay? If an entity has a contract that is onerous, the present obligation under the contract shall be recognized and measured as a provision. Okay? So this simply means that because there is an amount that needs to be paid in the onerous contract, we simply need to recognize it as a provision based on and recognize it based on the amount as computed in the measurement basis stated in the previous paragraph. Next, restructuring. So again, the only problem with restructuring is that some entities are actually mixing or including in the restructuring provision those that are on a continuing basis. We need to understand that if you are trying to provide a provision for restructuring, we must only recognize a provision for the non-continuing component. Any component that is on a continuing basis, meaning you're going to spend that because you're still going to continue the operations, are not part of restructuring because restructuring only pertains to those that are pertaining to the termination, okay, termination or ending a particular operation. Okay? So, what are some components, okay, or what are some items? Because the list is not actually exhaustive, so any similar item can also be considered as part of the restructuring provision. So first, sale or termination, okay, of a line of business. Any amount or any obligation that you will incur in relation to the termination or sale of a business is part of the restructuring provision. Next, closure of a business location. Third, change in management structure, meaning example, you're going to remove a management level, you're going to remove employees, you're going to retrench employees, so meaning you're going to incur an obligation in relation to paying those involved in the retrenchment. So that's going to be restructuring. And then fundamental reorganization that have a material effect on the nature and focus of the entity's operation. So fundamental reorganization simply means that you're going to change the purpose of your business. So still, this is going to result in obligations to be paid to parties that will no longer exist or no longer be involved with the business after the restructuring happens. Okay? So again, to reiterate, the restructuring provision should only contain amounts that relates to the termination or to the non-continuing operations of the business after the restructuring. If the amount has both terminating or non-continuing and continuing um, components, we need to dissect those and only consider the non-continuing components, and those are the amounts to be recognized in the restructuring provisions. Okay? Next, a constructive obligation to restructure arises only when an entity, letter A, has a detailed formal plan for the restructuring, identifying at least the part that is going to be restructured, the principal location, the functions that is going to be terminated, the expenditures, and the timing of the implementation, and the entity already has raised a valid expectation in those affected that it will carry out the restructuring. So meaning, before we can recognize any restructuring provision, we must first make sure that we met letter A and letter B. Okay? Because that's the only time that we can recognize a provision for the restructuring. Okay? We will not go through with these items because these are basically similar to the ones explained there. Okay. Let's just go to paragraph 78. No obligation arises for the sale of an operation until the entity is committed to the sale, i.e. there is a binding sale agreement. So this is similar to PFRS 5 or IFRS 5, non-current asset held for sale and discontinued operation. So we cannot consider the sale as probable if there is no binding sale agreement yet. Okay, so meaning we cannot recognize an obligation or restructuring obligation unless we are not yet sure or there is already a certainty that the sale will actually happen. Okay? Paragraph 80, a restructuring provision shall include only the direct expenditures arising from the restructuring, just like what I explained a while ago. We only focus on those that are relating to the termination and the discontinuance. Any continuing cost will not be part of the restructuring provision. So example of those costs are retraining and relocation, marketing, and investment of new systems, because these items are actually relating to what will happen after the restructuring. So these are continuing costs. Okay? That's basically what we talk or what is important for restructuring. Okay? We have disclosure requirements. So hopefully, I think during the last board examination, there were no questions that are really asked relating to disclosure requirements, because what was tested are the main concepts pertaining to recognition and measurement criteria. So let's go to disclosures. For each class of provision, because take note, there are going to be a different category of provision for different contracts or different obligations that the entity will be involved in. Okay? So again, you're not supposed to mix, or we're not supposed to combine provisions. So each item must be considered as a single class. Okay? Or if there are multiple provisions pertaining to a single obligation, then it is also going to be considered in one class only. Okay? So, what are the disclosures? The carrying amount at the beginning and end of the period, additional provisions during the period, amounts used, unused amounts, and the increases during the period discounted due to the passage of time. So meaning most probably this is pertaining to the amortization using effective interest. Okay? Also, comparative information is not required anymore, because basically comparative information is only pertaining to those that are existing from one period to another, such as example, accounts payable last year and accounts payable this year. Okay? So for provision, the reason why comparative information is no longer required is because most probably provisions in the previous period are not the same as the provisions in the current period because they pertain to different transactions or different obligations. Okay? An entity will also disclose the following: description on the nature, obligation, and expected timing of any outflows, indication of the uncertainties and timing of the outflows, any amount, the amount of any expected reimbursement, if any. Okay? And then, unless the possibility of any outflow in settlement is remote, an entity shall disclose for each class of contingent liability the following: an estimate of its financial effect, an indication of the uncertainties, and the possibility of any reimbursement. Okay? So, all others are just disclosures pertaining to, of course, when you talk about disclosures, these are talking about, aside from the disclosure requirements for provisions, it is also going to talk about disclosures of your contingent liability and your contingent assets. Okay? So, again, for contingent liabilities, if it is already probable, or sorry, um, if it is not remote but it is possible, okay, then it becomes disclosed. But if it becomes probable, then it will become a provision. Okay? In the case of contingent assets, we need to wait for the contingent asset to become virtually certain before we can accrue or before we can recognize it in the financial statement. So if it is not yet virtually certain, meaning it is still probable or it is only probable, then it is going to be disclosed only. So anything below probable for contingent assets are considered to be negligible and you can actually ignore them. Okay? So again, transitional provisions are not needed anymore because the transition is actually before or is actually done already. So no need to determine the transitional provision because it has already been in existence. Starting actually, this was 1999. So most probably no transitional provisions are going to be applied anymore to entities right now. Okay? Effective date, no need for that. We just simply need to understand that because of the new standards, there will be additional disclosures and other requirement that needs to be satisfied under the new standards, not specifically for IAS 37. So with that, that's the end of the discussion already. So these are just the persons who signed the standard, and that's the end of the discussion.